Okay, here to talk to you about Noyack. I'm CJ Follini, founder and CEO, and I have Sam Suechting. Sam, you want to intro?
Hi, Sam Suechting here, co-founder, and I lead up BD and strategy for us here at Noyack.
We are the hub to learn, interact, and invest in private markets, providing a community with education and expertise. This is why we're doing this. 4.4 trillion with a T is going to be inherited by millennials and Gen Z in the next 2.5 years. 38 trillion in the next 20 years. Those numbers are undeniable and they are massive. But there's behavioral problems as well. One, they already are primed to adopt primed to adopt private investments as a significant portfolio allocation. They believe it's the only way to truly create generational wealth versus just getting rich quickly.
Well, and I think the reason that is, CJ, is just that, the Great Recession, 08, 09, really left a bad taste in their mouth. And they don't trust the same media outlets that their parents do either. So there's a number of reasons why that is, but you can see it in the numbers here. They're already averaging a 3 times higher allocation to private markets than their parents did, even if it might be a lower dollar amount, at least to start.
But the acceleration, the year over year growth is accelerating far faster than my generation, Gen X. And you're right. I think there is a mistrust in every FTX, every SVB, every great housing crisis, and on, undermines their belief in the system. And frankly, I don't see a future for independent financial advisors when there are the tools for all of these investors to educate themselves and empower themselves, and we want to be at the forefront of that. Obviously, the problem, Sam, too complex by design in order to perpetuate their own need. The advisors create complexity. They're trying to validate why they exist. But in a self-directed world where millennials and Gen Z are moving towards, that's going to be harder to maintain. Plain spoken, direct, straightforward information, fees will always be more valuable. The fragmentation, moving from platform to platform, you have to be holistic. When have you ever, Sam, wanted to go to 5 places to do one thing? Right?
I won't, is the honest answer.
And you are, wait, Sam, are you millennial? No, you're actually Gen Z, of course. You're Gen Z. You're 26, 27?
It varies. I was born 96, so some people put me as the youngest millennial or the oldest Gen Z.
Actually, you're a zillennial. You might be cusp Gen Z. You are the true zillennial. I didn't realize we had a zillennial here, Leon. Sam is a zillennial. Oh, you are too? Oh, Leon, our producer, Sam, is also a zillennial. Wow, we're chock full of zillennials. Love it. Inaccessibility, that's existed forever because that's really because the CAC is too high, so they have to take high minimum checks. And yet they're reinforcing or they're accelerating their own demise by the inaccessibility. Giant minimums, needless complexity is making what should be a much greater adoption impossible. Let's change that for aspirational investors, Sam.
Couldn't agree more.
Learn, interact, community, and access to investment. Learn, interact, and invest, the holistic one-place hub. This is, for me, whether it's Noyack or someone else who does this is the win. And frankly, the market is ready and primed to accept this. That's why our tagline is access granted. Education, research grants access. Community of peers and also grants and accelerates access. And obviously, the direct enablement is the access granted.
And I think it's worth noting, CJ, that we don't want to disrupt the whole RIA and traditional financial community. We want to bring them into this new investor persona and new tech stack and be their front end. So this is not a zero sum game. It is positive sum. It's a question of how do we not all duplicate spend on tapping into these huge dollars you can see on this slide that are going to flow to millennials and zillennials over the next 5 to 10 years.
Uh, couldn't agree more. Obviously, we want to bet on a year over year growth. We want to bet on a demographic and an obtainable market that's growing. And while the absolute amount of assets and the addressable market is larger and considerably larger in Gen X, the adoption is less and it's declining. So the future is clear, and the future is in younger aspirational investors. Greater adoption, growing assets. Tell me what we're thinking here as in terms of value-based pricing.
So essentially, we're sort of turning the model on its head. Whereas most traditional financial institutions and asset managers have always focused on the transaction into their Reg Ds or whatever product they're selling. We're doing the opposite. I mean, that's sort of the carrot at the end of the funnel for us. We want to monetize throughout the funnel. Whether you come on as a free audience member and then you might convert by buying a single a la carte report. A due diligence report on an investment offering that we've reviewed, and then ultimately becoming a subscriber and an investor as well. The idea is that we're deploying SaaS metrics that have been around for 10 plus years now into the financial industry, which is still stuck on the 2 and 20 model that is certainly older than I am. So
And
I
I
don't
don't
think
think
most people
anyone, sorry, Sam, but I don't think anyone believes that the 2 and 20 is a value oriented approach, and yet they've never ever changed it.
Yeah, I mean, this is essentially talking about investment in terms of lifetime value and not in terms of a single paycheck when you
Right.
exit your fund in 7 years.
Yeah, I mean, it's such a myopic point of view of your customer to extract exorbitant fees for every action rather than paying it forward doesn't really concern itself with having that customer for life, and they should. I love the education
Agreed.
as a service. I actually think that education and education as a service could be the greatest impact possible, and as specifically on these demographics in the wealth generating business.
Well, and this gets back to our point about inaccessibility. There are scarily few people who have 500,000 or $1 million to invest in a private placement, but there are a lot of people who have $8 a month to dip their toe in the water and then ultimately get access to a private offering at a significantly lower uh, subscription price.
And more importantly, then once they do, with the education and the community that they've experienced, they might make fewer mistakes. Then when they do invest that amount which is precious to them, it has a greater opportunity for success.
Agreed.
The fees, well, those are two ways. I mean, obviously private investment fees, but for me, I think that the private investment fees are the product extension, and they are a culmination of all of the education, the research that has been offered and consumed.
Agreed. I think there still is a place for traditional fees, but they need to be aligned and lower.
And transparent. That's one as you see from the research reports.
Yeah, we'll get into that in a couple slides.
Ah, this is all your scalable investor acquisition. Go ahead, Sam. Look at that. Oh, $3,200 for the typical registered investment advisor acquisition cost. It's a lot of money.
Yeah, so that's the upfront cost to acquire, a Gen Z or Boomer investor in the traditional way, and that's both real cash down and then also in terms of labor cost as well. It's utterly unscalable. I don't know how many average clients an RIA has, but obviously it sort of plateaus at some point because you can only scale yourself so much. So what Noyack is doing is taking a funnel-based approach where we're acquiring audience, consumer, subscriber, investor. The CAC is spread out throughout the funnel and lower. And ultimately, that helps our CAC to LTV ratio over time so that the unit economics actually work. If you take the old way and try to put some sort of digital lipstick on it and attract these new millennial investors, it just doesn't work. Like the economics fundamentally don't work. You see these new platforms, they have a $600 subscription price per year. When you actually start doing the math around how much an average investor has to have deployed in that platform for the subscription prices or the monetization they're charging, it's unattainable for most investors and doesn't make sense. So our funnel-based approach is about lowering the customer acquisition costs and then nurturing investors throughout their financial journeys. And like we've said, most of these Gen Z and millennial investors don't have a ton of money right now, but they will in 5 or 10 years.
Also, no one learns in a linear fashion anymore. It's all asynchronous. So to not present a multi-format, omni-channel method of learning with different types of content makes no sense, and it's going to be unsuccessful. I love the fact that while someone may only listen to or learn from a research report, many others only want to listen to a podcast or watch our video cast. And yet there might be long form articles for others. Meeting people wherever they are in the way they want to be reached and communicated to is the ultimate success and impact.
Well, and the point is that the incumbents aren't doing any of those different strategies. I mean, they're sending out a report once a quarter on linen cardstock, and that's about the extent of their marketing effort.
Okay, so defensibility. Well, we all know that education and content is hard to do. So there's an initial moat right there. Lowering the CAC attracts the co-sponsors. So I see what you're saying. There's a flywheel. There's a network effect that will create a tremendous scalability to customers. I love the fact that future co-sponsors bring their own audience, which we then consume and add to our audience.
Well, it's virtuous. It creates liquidity. It creates engagement, and that's why we want to position ourselves as a friend to traditional financial firms and RIAs, and not as a foe. This is additive.
True. It's always vectored approach with other firms. They get you. They attract you. They speak to you. There is no virtuous cycle. It's really, I say vector, but maybe it's different. Okay. Economic scale in the funnel over time. I believe that. I think the previous network effect showed that to be true.
Agreed. What this is really about is that, whether we have 3 different products, we've got consumer, subscriber, and investor, and there's a different LTV to CAC associated with each of those. It's pretty expensive to acquire someone as a consumer. We've got to produce content. We've got to get them first to our website as audience, and then ultimately to purchase a report or another offering that we have on our website. That's expensive, and the CAC to LTV really isn't that good. But if we can nurture them over time and they're getting a report once a year, twice a year, and then ultimately becoming a subscriber and investing, that is the on-ramp to the much larger opportunity, which is the aligned investment fees and ultimately our subscription product as well. And that's exactly what this is capturing over time. This is split up by cohort and not by actual fiscal years.
Right.
So this is, again, substantiation of our SaaS metrics approach to financial investing as opposed to a transaction-based approach. And I think, it's visually pretty powerful, as you can see.
Well, I think the conversion, we believe that the conversion of a warm relationship that the customer subscriber has received value over time, the ask to become an investor, the conversion will be exponentially higher than, say, dialing for dollars, which, crazily the entire industry is still doing.
Yeah. Ineffective cold outbound. Ineffective is barely scraping the surface of how dire cold outbound has become. But
0.5% on email automation, which it should cease entirely. The whole email automation is not working. But listen, lower CAC, increases conversion. Lower CAC, increased conversion, the story. Okay, well, I'm glad we started. We did a reverse build. We followed what you presented to me as Jeff Bezos and Amazon's approach of manifesting the end of the build, and I think these are all very impactful. $100 million in assets raised, actually $105 million in asset raised, part of our minimum viable product, and as well as our proof of concept. And it was really
what I
hard
think you're
to do.
getting at is that, we built discrete offerings, 5 discrete offerings before we built the platform to unite them.
Yeah.
And this, overcomes a chicken and egg problem because there's actually inventory and real products with, 100 million plus in gross asset value on our platform from day one. These are ones we've built. We certainly want to invite co-sponsors to tap into what we're building as well in the future. But we think this is a really good foundation to start from.
Like we've always said, 5 is on the way to 50, Sam. So the rest will be co-sponsors that are vetted and approved. And that is when that flywheel, that network, I keep saying flywheel, that network effect really takes hold. Differentiation, clearly. It's amazing to me that I guess the difficulty of creating meaningful education and in a multi-format has been so hard that everyone always takes the path of least resistance, even if it's not the most successful. That surprises me. But I mean, we all believe, Sam, that this is the only way to success, is to educate first, provide context, right?
Absolutely. And then ultimately to provide, good investment opportunities as well. I mean, there's a few names on here, and maybe I won't call them out, but we're going to see what their returns are in about a couple of years, and they're not going to be good for investors because their fees are exorbitant and they're hidden, and they're not, frankly, doing what they say they're doing.
True. Well, you know what? Listen, at the end of the day, performance trumps all. Now, our performance can be evaluated differently, Sam, through what was our education valuable? Did it inform? So we have different metrics to be judged upon rather than just, were your investments successful? So if you were going to be truly holistic, we have to start on the front end and yet also perform on the investment back end. Wondering about the siloed approach. Should this really be included after the last slide, Sam?
You mean it's duplicative?
Yeah, do you think so? I think so. What do you think?
Yeah, no, I think what it gets at is that, this gets back to the fragmentation point, including among the new entrants. And, we're exciting. We're trying to solve it. Education, everyone has an insights tab on their website, but it's not a revenue driver for them. It's not a P&L driver, so it's an afterthought. For us, it's an actual product, and that drives our network effect. Whereas for them, it's a check the box to make sure it's there for SEO or something.
Got it. I'm really happy that we took the time to do this, and in how we're building this fundraising effort so comprehensively that I'm glad that we really listened and talked and surveyed potential customers. We learned a lot, right?
Well, I think these speak for themselves. I mean, if we do the reciprocal of the one on the right there, the number is that 93% of young investors don't speak to traditional financial advisors. That's a pretty shocking number.
It is. I can tell you with the faces in the room when I presented that, where most of the attendees were traditional legacy financial advisors at the Global Wealth Tech Summit where I was the keynote. Yeah, there was not a. They didn't respond well to that. To that number. they saw their end in clear view. Good start. We have a long way to go, right, Sam? Good start.
Yep.
Why you shouldn't. Content is hard and expensive, Sam. It really is. There's a lot of people in the so-called wealth tech category. We're pretty young, with the exception of moi. Everyone else is. And we don't care about sales. Value. Can those be responded to?
Absolutely. I think because we're taking a funnel-based approach, first of all, we're young. We think we're good at content. We know it's hard. It's going to be expensive as well, but we are capital efficient. Secondly, we have multiple shots on goal because we have multiple products. It's not a binary transaction like most of our competitors are peddling. Um, and lastly, I think it's becoming increasingly clear to everyone in the industry that this cold outbound approach has run its course. And I think, it worked in the heyday of email, but if you talk to someone under 30 about how they're going to be reached, it's not via email. And that is fundamentally what we're laser focused on over the past 18 months and over the next
By the way,
this year.
it took me as a 56-year-old a long time to come to that reality that you and all the other team were so clear on. I was just grasping, or I was gripping that that old legacy email outbound buy us, we're great mentality for all it was worth, and it's not worth anything. There is a way to nurture, but it's not outbound email.
Yeah, agreed. And that's what our whole approach is about.
As I've said before, thank God for generative AI, or thank God for image AI. Helped me a lot here. Great team, good start. Really, I'm really proud to work with everyone. Interesting things. I am super enthusiastic about the working with IBM and Converge on the AI-powered personal risk score. What do you think about the
That
reality of
plus,
that by the end of the
I
year?
think Noyack Academy is exciting.
Good point.
I
I
think
do
it's definitely
too.
attainable,
Yeah.
especially with some of these new AI models and tools that have come out. It's become much more so, and we're going to be
Hmm.
first to market with that. And then I'm also personally excited about the Academy product as well. Like we've said, most people just don't know what a Sortino ratio is, and they don't have to know. I mean, that's not the point. But making this industry and market accessible to them is fundamentally why we're here. And if they want a more rigorous entry into the private investing world, that is what the Academy is going to accomplish.
It's almost like the Academy could be the Rosetta Stone between the individual aspirational investor and the professional investment advisors. They're going to need translation, right? That's an interesting idea to call it a Rosetta Stone.
Yeah, I think it's a good analogy.
Also, who said that? Trish also, we're the bridge. That's another way to call it. Or Coley said it. So we can't end that. We can't end this little presentation without saying we're raising money. We're doing it in a different way. It's an open safe in 3 different tranches with 3 different discounts, and the first tranche is $3 million with a 25% discount. We don't want to take bandwidth every year having to do another round, so we don't do the same old, same old. It's sort of it's part of our mantra. We do things differently, and that extends to how we're raising capital. But we have a great start. Thank you, Sam. It's been great talking to you about what we're about to get started on.
Likewise. Thanks, TJ.
All right.
Bye.
See you soon, Sam.